For many households, financial pressure does not arrive in one dramatic moment. It shows up gradually. A grocery bill runs higher than expected. A utility bill becomes harder to absorb. An insurance payment takes a larger share of the paycheck. A rent or mortgage payment leaves less room for everything else. Then, quietly, the credit card fills the gap. Not because every household is spending recklessly, not because every purchase is unnecessary, but because for many Americans, the margin between income and expenses has become thinner. That is the credit card economy nobody planned for. In the first quarter of 2026, total household debt in the United States reached about $18.8 trillion, according to the Federal Reserve Bank of New York. Credit card debt stood at $1.252 trillion. That balance fell by $25 billion during the quarter, a decline that can happen seasonally after the holidays. But it was still $70 billion higher than 1 year earlier. That distinction matters. A quarterly decline does not erase the larger level of debt households are carrying. And for people who carry balances, the cost remains high. Federal Reserve data showed that in the first quarter of 2026, the average credit card interest rate for accounts assessed interest was 21.52%. At that level, a credit card is not only a payment method. For households that cannot pay the full balance each month, it becomes expensive short-term borrowing. A credit card can make a difficult month easier to manage. It can cover groceries. It can keep a utility bill current. It can absorb a medical bill, a car repair, or an insurance payment. But when the balance is not paid off, this month's solution becomes next month's obligation. That is how everyday cost pressure can turn into long-term household debt. The system behind it is straightforward, but powerful. Households face the combined cost of food, shelter, utilities, transportation, insurance, and services. When those costs rise faster than available cash, something has to absorb the difference. Some households use savings, some reduce spending, some delay bills, some turn to credit cards. The Federal Reserve's 2025 household survey found that 58% of adults said price changes had made their financial situation worse. It also found that 16% of adults did not pay all of their bills in the prior month. Those numbers do not mean every household is in crisis. They do show that price pressure is still affecting household cash flow. And when cash flow weakens, credit becomes more important. This issue is not only about the size of the debt. It is about what the debt represents. A household can look stable from the outside. The bills may still be paid. The groceries may still come home. The car may still be running. But behind the scenes, part of the household budget may be shifting from the checking account to the credit card statement. That is a quieter form of pressure. It is delayed. It is easy to miss. And it often becomes visible only when the monthly payment grows. The Consumer Financial Protection Bureau reported that credit card debt exceeded $1.2 trillion at the end of 2024. It also reported that consumers were assessed $160 billion in credit card interest charges in 2024. That figure shows the cost of carrying debt. Interest is not food. It is not rent. It is not gasoline. It is not medicine. It is the price households pay when today's expenses become tomorrow's balance. For middle-class families, this can create a difficult loop. Prices rise. The card absorbs the pressure. The balance grows. Interest adds another cost. Then the next month begins with less room than the month before. This does not describe every household. Some people use credit cards and pay them off in full. The New York Fed makes that distinction carefully. Credit card balances include both people who carry unpaid debt and people who pay their balances every month. So the balance number alone does not prove financial distress. But when elevated balances are combined with high interest rates, bill payment stress, and cost of living concerns, the picture becomes more serious. The issue is not that every American is living on credit. The issue is that credit is becoming more important as a buffer against household pressure. That pressure is not evenly distributed. Federal Reserve survey data showed that financial well-being declined among young adults, low-income families, and Black adults. This matters because national averages can hide unequal strain. One debt number can look stable. One delinquency number can look manageable. But inside individual households, the experience can be very different. A household with higher income, savings, and no revolving balance may feel inconvenience. A household with tight income, limited savings, and a high interest balance may feel trapped. That difference is the human impact. The same economy can produce very different financial realities. One family uses a credit card for rewards. Another uses it because the utility bill is due. One household pays in full. Another pays the minimum. One balance disappears the next month. Another becomes part of the monthly budget. This is why credit cards are such an important signal. They sit at the intersection of daily spending, emergency savings, income pressure, and interest rates. They show how the cost of living moves through a household, not as one dramatic event, but as a series of small decisions. A little more on the card, a little less in savings, a higher minimum payment, a balance that lasts longer than expected. The Federal Reserve's April 2026 consumer credit data showed revolving credit growing at a 10.4% annual rate. Revolving credit includes credit card debt. That does not prove why people borrowed more. It does not prove that all of the borrowing was for necessities. But it does show that revolving borrowing was expanding again. And when revolving borrowing grows while interest rates remain high, the cost of carrying balances becomes an important part of the story. Inflation is often discussed through prices. The cost of groceries, the cost of shelter, the cost of insurance, the cost of energy. But credit card interest is another layer. It can turn those expenses into something heavier. If a household puts everyday costs on a card and pays them off quickly, the card remains a tool. If the household cannot pay them off, those same expenses begin to carry interest. A grocery bill from last month can still be costing money this month. A car repair can follow a household for months. A medical bill can become part of a revolving balance. That is how cost pressure stretches over time. The current data does not support panic. It does not show a broad household breakdown. The New York Fed said aggregate delinquency showed little change in the first quarter of 2026. But it also showed that 7.10% of credit card balances flowed into serious delinquency. Early delinquency transition for credit cards was 8.6%. Those figures show where pressure may be appearing. Not every borrower is falling behind, but some borrowers are. And once a credit card account becomes seriously delinquent, the issue moves beyond the cost of living. It becomes a payment problem, a credit problem, a future borrowing problem, and for many households, a source of sustained financial stress. The deeper issue is fragility. The Federal Reserve's household survey found that 63% of adults could cover a $400 emergency expense with cash or its equivalent. That means many could. But it also means a significant share could not. For those households, an unexpected expense is not just an inconvenience. It may require borrowing. It may require delaying another bill. It may require carrying a balance. And when interest rates are high, that choice becomes more expensive. This is the credit card economy nobody planned for. It was not designed by one company or one agency. It is the result of many pressures meeting at the household level. Prices remain elevated in important categories. Credit card interest rates remain high. Emergency savings are uneven. Debt levels are large. And some households are using credit to keep ordinary life moving. For a documentary about the middle-class squeeze, the credit card is not the villain. It is the evidence. It shows what can happen when ordinary expenses become harder to cover with ordinary income. It shows how pressure can remain hidden. And it explains why stable headline data does not always match household experience. A household can be employed and still under pressure. It can own a home and still struggle with insurance. It can have income and still carry debt. It can appear financially normal while relying on credit to stay current. That is the quiet part of this story. Many people do not fall behind immediately. They adjust. They stretch. They move expenses around. They use the card. They pay what they can. For a time, the system keeps working, but tomorrow begins with yesterday's balance. The current picture is clear. U.S. household debt remains near record levels. Credit card debt remains above $1.2 trillion. Revolving credit expanded in April 2026. Credit card interest rates remain high for accounts assessed interest. And price changes remain the most common financial concern reported by adults in the Federal Reserve's Household Survey. What remains uncertain is how long households can keep absorbing pressure this way. That depends on jobs, wages, inflation, interest rates, emergency savings, and whether everyday costs keep forcing households to choose between paying now and borrowing for later. The story is not that every American is overwhelmed by credit card debt. That would be too simple. The story is that credit cards have become one of the places where the cost of living squeeze appears. For some households, they remain a convenience. For others, they are a bridge. And for the most vulnerable, they may become a trap. That is why this issue matters. Because the bill does not disappear when it moves to a credit card. It waits. It grows. And eventually, it comes due.